Manish Kumar, Investment Head with ICICI Prudential Life Insurance. Manish, good morning and thank you for joining us. First, let's talk about 2013. Very challenging year, very volatile year. First, rupee plunged and then markets recovered. Markets are at an all-time high, but no one is happy.
That's actually interesting. Are you not happy?
Actually, you're right in some way that markets seem to be at an all-time high, but that is looking at the index, which of course is at an all-time high, but that is possibly happening because probably 20 stocks in the index are at an all-time high and much higher than the peak that we had seen in 2007. But if you look at the broader market, I think quite a number of stocks in the market are at valuations which are at a fraction of their peak valuations, which we saw in December 7, January 8 levels.
That was a bull run. That was
right.
Is it fair to compare that now?
So that's why I'm saying probably if people are not feeling very enthusiastic about it, it's partly to do with the business environment which is still showing stress, and also because it's not really markets that have given a return in aggregate, but basically few stocks that have done well, which is actually lifted the index up.
And also retail participation is at a 10-year low.
Yes.
So, nobody's really made the money in the market.
Right.
Does it get harder, you think, from here on to make money?
In fact, I would be more optimistic on that account, and there are reasons for thinking like that. One is, if you look at what has happened in the retail investments space, a lot of money has gone into I would say, real assets from financial assets. In fact, financial sector savings as a percentage of GDP has been declining in the last 3 years. And probably some of that has gone into gold and real estate. Now, gold has already lost sheen in the last couple of years. In fact, dollar investors have lost quite a bit of money in gold. And because of only currency depreciation, for Indian investors, it is actually looking flattish. This is for the last couple of years. As far as real estate is concerned, commercial realty anyway has been in the doldrums, and residential also has not been really making money for them in the last couple of years. So I think going forward, we'll start seeing flows coming into financial assets, and we are already seeing signs of that in some of our income funds.
So are you getting more inflows and less outflows in your schemes?
I would say on an aggregate basis, yet the outflows and the inflows match. But what is happening is we are getting surrenders on some of our older platforms that carried higher exposure to equity. And therefore, as far as equity asset class is concerned, we are seeing outflows. Whereas we are seeing inflows in some of our traditional plans and some of our ULIPs, which are more income oriented. So in a way, flows are skewed towards income funds.
But that would be interesting because globally the trend is allocation shifting to equities. When do you see that happening in India? When do you see all these outflows turning into inflows for equity funds essentially in schemes?
Let's try and understand this from a retail investor point of view. A retail investor is making roughly about 9 to 10% kind of return per annum in the bond funds. If you just remove or set aside the last 3-month volatility, because let us say if I were to invest in a bond fund, the chances are fairly high that I'll be making high single-digit to low double-digit kind of returns over the next few years. So from a relative attractiveness point of view, I think it's a very good place to invest. Globally, if move has happened towards equities, that is because global interest rates have been at an all-time low levels, which has not been the case in India. So in the Indian context, for money to move in a big way to equities, I think first the bond markets will have to rally, and then we'll start seeing a rally coming into the equity markets.
Okay, so what's the case that you're building for Indian equities in this year, in 2014? Do you expect retail participation to come back, and do you think that the macros would be supportive of a further move from here for the market?
I think as a second leg, yes, we are quite confident. We believe that as a second leg, we'll start seeing retail participation coming back into Indian equities. But initially, we expect the momentum to continue in the fixed income side, and you are actually seeing that both in the case of insurance companies as well as mutual funds. In the mutual funds as well, there has been an accretion to corpus, but most of them has been happening on the fixed income side, and in a very small way it is happening on the equities side.
So we should blame mutual funds also for the selling. We should not just blame insurance companies. Okay, I have a very basic question for you. We've seen 2 years of single-digit earnings growth.
Right.
The best earning projection for next financial year, which is FY15, is about 12 to 13%. Markets are already expensive. If earnings growth will be in early single-digit, why should equity investors come back to equities?
Well, you are right that on an aggregate basis, the earnings growth for next year could be at best in low double digits. After a single-digit growth.
That's the best-case scenario.
Yes.
Which is assuming that nothing goes wrong and things only look up.
Yeah. But as I said in the beginning of our discussion, it is only about 10 to 20% of the stocks that are really expensive. If you look at the whole set of stocks, be it in the infra space, be it in the auto space, be it in the hotel space, there are so many other sectors where the valuations are actually far more reasonable. What is actually preventing the stocks from going up is the current weak business environment. The auto sales look weak, the cement volumes look weak. So right now there's a lot of stress in the system which is getting priced in some of these companies. So even if there is a moderate, some sign of modest recovery as well, we'll start seeing some of these stocks doing well. So it is possible that index as a whole may not give extraordinary returns, and that has been our view for some time, because the more expensive stocks may not continue to remain as expensive, and some of the cheaper ones that may not be having very high weightage in the index may actually do quite well.
You know, historically, insurance companies are always considered as conservative, and why not? This is public money you're dealing with. The whole game, your objective here is to gain less but to save more. Yeah. Are you ready to take that leap of faith? Are you ready now to revisit the beaten end of the market, the shredded end of the market?
In fact, we have already done so in a small way in the last 1 year, and we will continue to do it. But at the same time, we have to be cognizant of the fact that while we take a long-term view, we are not going to be driven by sentiments, and we would not like to be driven by just by the flows, because the flows are actually also impacting the valuations of some of these companies without any significant improvement in the fundamentals.
IT and pharma is still your large holding, which means you're still sticking to defensive and quality.
Yes.
So there is no big change in stance per se then from you.
Actually, while IT and pharma have been big holdings, but then so are our exposures in sectors like auto, banks, telecom, and even in some of the infra companies as well. In fact, if you go back, say a year back, we were hardly having any exposure to the EPC space, whereas recently you would have seen us taking some exposure in the EPC space as well. So somewhere we are also playing the possible turnaround in the economy, but in a limited way.
Yeah. Manish, you were talking about the big ideas that you're convinced of in the markets into the new year. What is it that will draw your interest right now? Because, while you talked about the underpriced stocks, there seems to be a lot of focus building on mid caps and small caps. Do you think that is where the market will be focused on, or money will focus on?
See, a lot of mid caps seem to have rallied because large caps had already rallied prior to the elections, and therefore some money has gone there. But somehow, when we're looking at the underlying performance of some of these mid caps, I think probably there is still some time to come where you will start seeing performance supporting the valuations or the recent rally. Therefore, we would not like to be swayed by the recent liquidity-driven rally in mid-caps, and we would like to remain focused and selective. As far as large caps are concerned, we would like to maintain a balance between some of the expensive but the good companies, which are actually a great franchise. And by the way, while they are expensive, they actually happen to be the best performing companies also in their respective sectors. And they have been continuing to do well. And even now we believe they will do well. But at the same time, what we are also doing is we are trying to create some beta in the portfolio by investing in certain companies that have not done anything in the last 5 years. They have managed the tough times well. And the bad news of low growth or weak order booking or weakness in margins is already priced in. So trying to strike a balance between the expensive companies and not so expensive ones, but good franchises.
I smell L&D there.
So what else are you buying from the infra space? Because I can really divide the infra space into a lot of subsectors. You've got construction companies, you've got asset owners, you've got pure capital good companies, you've got some export-oriented businesses. What exactly are you buying from infra?
In the infra space, we are right now focused basically on the EPC category. There are certain companies that have demonstrated a lot of resilience in the last 5 years. Just imagine country's GDP growth decelerating from 8.5% to about 4%, and yet they've been managing to get at least a similar kind of ordering year after year. Yet they have been able to at least maintain their absolute profits. They may not be showing any profit growth, but in circumstances like these, their profits could have halved or completely evaporated. Yet they have been able to sustain themselves. So right now we are sticking on the one or two large cap ones, and there will be one or two small MNC companies which are actually good. But again, in the EPC space, we are not yet talking of investing in asset owners, partly because the balance sheets are still in stress, partly because of so long as the interest rates remain high, I don't think they're coming out of stress so easily. And then there are governance issues with some of these companies.
Is there a tactical trade in PSU banks, not a structural trade, but more like a tactical trade with the assumption that rates will come down, Reserve Bank of India will cut rates, bond yields will come down, and that will fuel the treasury income?
Well, such tactical trades may have played out many a times in the last 5 years. But as such, it hasn't really worked for investors who have been hanging on to PSU banks, as you can see in the performances as well. And as far as any possibility of future tactical trade is concerned, at least for now, we do not believe interest rates are coming down in a hurry. What we can say with higher certainty is that interest rates may not be going up, but the current high interest rates may actually remain and may last for a while.
How much focus do you think energy would garner in the coming year, given that there's much talk about policy reforms which could be initiated in the sector?
You're referring to oil sector specifically or power?
Power, oil, but largely the energy space, the resources space as well.
Right. See, as far as oil sector is concerned, we are actually getting a little constructive now, because some of the, I would say, small ticket reforms that have been taking, especially a 50 paisa per month diesel price hike, it seems to be coming notwithstanding what is the political outcome, notwithstanding whether we are very close to elections. So contrary to market belief, we are seeing the government actually pushing it gradually. We are seeing some attempts to increase the gas prices. So while there may be some opposition to that, but I think eventually when that will happen. So just imagine an environment where eventually, because of tapering, we see global commodities cool off a little bit. Let us say a crude goes off to $100. Let us say diesel price hike continues at the pace of 50 paisa per month, which means a 12 rupee price hike over a period of 2 years. The oil sector dynamics will start looking different.
So for the moment, you don't own PSU stocks or OMCs?
We don't own PSU banks, but oil PSUs, we are certainly very much there. And actually, we are slightly overweight in some of those.
What could really trump our today's discussion is just one thing: flows. US economy, which was considered as the biggest liability for the world economy 2 years ago, for 2014 will be the biggest growth engine. Developed markets are already doing well with in versus emerging markets. Those who've invested in India 4 years ago, they are losing money because of what's happened to dollar. Do you think flows for 2014 could be challenging? I'm not getting into tapering. I'm simply mapping performance and returns.
Partly because of how the US economy is likely to do, and partly also because of tapering. Yes, there is a possibility that flows in 2014 could get challenged. In fact, if I can divide this flows into two parts, there is one segment of investors who have come in who are actually buying companies or stocks. They are not really looking so much at the macro of the country. So there are some companies in this country which have done well irrespective of what is happening to the economy, and they are focused on those companies. That kind of flows may continue. At the same time, India has also been a beneficiary of the huge quantitative easing, and part of that $45 billion in the last 2 years is on account of that. So we may see some pause in that or some reversal in that. So on account of that, you can expect some disturbance on the flows.
Okay. Final word really, Manish. Same time next year, what do you think we could see on the markets, on the economy, and even on the currency for that matter?
Well, we are positive on the markets, but index as a whole may be up by not more than, I say, 8 to 10%. So we are not saying that index is going to be really flying very high, but there is opportunity to be made on individual companies in the index or outside the index, and that is how we are likely to be focused on. Currency, we can expect to remain stable in the short term, but depreciate in the medium term, because we still continue to run a reasonable current account deficit. But it will, I don't think what we saw in the months of July, August, we'll see a repeat of that. So probably a 5% kind of depreciation that we used to see in 90s, we can build that in a model. Interest rates in the short term, we expect them to remain range bound. We expect them to be flattish, and with a year lag, probably we'll start seeing it coming off.
Growth?
Growth should, I think somewhere in the last 2 quarters and maybe in the December quarter itself, again we'll see growth remaining between 4.5% to 5%. But getting into next financial year, we should start seeing some pickup in growth.